All right, may I have your attention? I'd like to call this meeting to order, please. If you will stand and recite the Pledge of Allegiance with me, please. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. All right, we do have a quorum. We have one excused absence from Director Vines, and we will move right into the approval of the minutes. Are there any changes or corrections to the March 10th Governing Board Workshop minutes? Okay, seeing none, they will stand as written. Moving right into new business, CapTrust Investment Strategy Education. Cliff, do you want to introduce our folks?
Good morning, Director Hurley. Good morning, Committee, Governing Board, excuse me. This is Carol and Nate from CapTrust. They're going to be going through a little educational session here on our investment strategies and portfolio. So with that said, Carol, I'll turn it over to you.
Thank you, yes, and I'll jump right in. I know we don't have a lot of time here, so I appreciate you all having us out. And it's a little unusual for us to be here today, a little bit different presentation that we'll do today. Usually we come quarterly and we meet with the committee and we go over the investments for recreation centers. Today, after last year having some hard conversations, I know the committee's been having hard conversations. We've had some hard conversations coming here. Community has had lots of questions and hard conversations. We just thought it would be a really good idea to come in and hopefully just have an opportunity to fill in some of those gaps that we don't have a chance to talk about when we come into the committee meeting. So I'm going to call this an education session today, and I'll keep it brief, but the purpose of today is to really just help everyone understand the basis of the portfolio for recreation centers and provide an opportunity for Q&A as well, okay? So I'll jump right in without further ado. And what I'm going to do is I'm going to start big picture, just talk about CapTrust. You've already hired us, so there's no commercial here. And then I'm going to talk a little bit about portfolio theory. Have to get into that, and I'll keep it really brief, but I think that will be really helpful in just answering a lot of questions about why are we doing this, why don't we do this. And then I'm going to talk very specifically about recreation centers portfolio, okay? We have been hired on a discretionary basis, so that means that we put in our best ideas and we have to implement our best thinking on portfolios for clients. That's what we're hired to do. To do this, it requires a great deal of market intelligence. CapTrust is one of the largest RIAs, registered independent advisors, in the United States. We're hired as fiduciaries. We work in your best interest, okay? We have an army of individuals who are located out of Raleigh, North Carolina. We have over 100 analysts. We have quite a bit of market intelligence that comes through, not just through our Raleigh team, our investment team, lots of names on here, a lot of topics on here which they will review. They meet bi-weekly, and they'll talk about the economy. They'll talk about the concerns that our clients have. We listen to our clients. We know that we're entering into lower return environments. We know that spending policies are pressures to go up. We hear all these concerns, and we're also implementing our best ideas given these concerns with the tools that we have to work with and with the economic environment that we have to work with. When it comes to discretionary portfolio management, we have to have a lot of intelligence. And the reason we do this is it's really quite boring. We just come up with mathematical models. We look historically at how different asset classes have behaved, stocks and bonds, and the various subsets within those categories, U.S. stocks, international stocks. In the bond category, we'll look at U.S. bonds, international bonds, corporate bonds, municipal bonds. We look at all these various asset classes. We look at how they have behaved historically. And then the most important thing to do is to project how do we expect these different asset classes to behave going forward so that we can implement our best ideas and come up with portfolios that will hopefully maximize returns but limit the risk given the risk tolerance of our various clients. Okay, so I do have to get just a teeny bit academic here. So just one slide, okay? So bear with me for a moment. When we're building our portfolios, so we'll just look at 2 axis points here. On the bottom here, we have something just called expected standard deviation. That's risk, okay? And then we have our return. We'll call this the y-axis. I don't know if you can see the red dot there. Going up and down, the y-axis is return. All humans want to be up here by the 8, which basically says, I don't want any risk and I want the highest amount of return possible. When we come up with portfolios, I'm going to go back just one slide here. We have to come up with assumptions for various different asset classes, and this is really interesting to look at. Everyone does this. Goldman Sachs does it. Merrill Lynch does it. Everyone will come up with their best assumptions going forward on various asset classes. These assumptions, we take the risk and return assumptions, we put them into our models, and if we plot every single different type of possible portfolio that we could come up with, we could plot all of those up on this graph. You're not going to find any, unfortunately, that are, no risk and 8% return. That's just, those don't exist. But what you do see here you see these little dots here, and what they will come up with is just something in academics we call the efficient frontier in modern portfolio theory. It's our basis for building portfolios. It's our best guess on a long-term basis. We're going out, we're looking at portfolios. An important point here is we're looking at 7 to 10 year horizons. So we're not looking at portfolios just this year with the debt ceiling. What's going to happen? How should we build this portfolio? This is long-term. These are portfolios built on a long-term horizon. Okay, and we understand that there's volatility. We understand that there's years like 2022, which are just complete outliers. But we know that when we build these portfolios on a long-term horizon, we look historically, we say, how did these portfolios act and behave, and can we expect them to do that going forward? Your portfolio is not on here. It's customized for you. These are just building blocks that we use. These particular portfolios, I won't go through all of the numbers and details here, but the point of this is these are just our best thinking, our best portfolios, the portfolios that we can put together within constraints at CapTrust that will give us the best return for the risk that's out there. And we use this as a basis. And this helps us quite a bit with when we do build portfolios for recreation centers and for clients at CapTrust. It just gives us a starting point. How much treasury should we have in a portfolio? Should we have all treasuries? How much U.S. stock should we have? We see the dollar value going up and down. There's all these different moving variables, and we're questioning how much of these different asset classes should we have in our portfolio, and this is the basis for that. Once we build portfolios, those particular portfolios that you saw, we have to manage them on an ongoing basis. And I won't bore you with all the details here. There's lots of documents and literature out there that you can get that you could read if you really like the fine print on this. But we're looking at expense ratios going forward. We want to make sure that whatever assets and individual securities that we pick for a portfolio, that they're going to maintain low expense ratios. We look at active management, which just means there's active management and there's passive management. Your portfolio is passively managed, meaning we're not necessarily picking active managers that are trying to beat any sort of market index. We can if you want to. We do have those portfolios available, but they're more expensive, okay? And it just wasn't something that was going to meet the needs of recreation centers. There's tracking error. We look at excess return objectives and asset allocation, and then we look at tactical implementation. So, and I know these. I won't go into all of these individually. If you have questions, I'm certainly we're here to answer any of these. But the point is that once we build a portfolio, we have certain rules and guidelines in place to be able to manage the portfolio on an ongoing basis. Okay, so that's just the base. Then we get to recreation centers. And the next 3 slides here are slides that you've seen before in our presentations. When we work with a client and they come to us and they say, here's our needs, we develop something called an investment policy statement. And this is the guidelines for the specific client for recreation centers. The investment policy statement with recreation centers, we were hired on a discretionary basis. We can implement our best ideas with the portfolio. We are fiduciary. So when we look at return, we're looking at capital appreciation as well as any dividends and interest going forward. The policy also states that there is a certain level of expected volatility within the portfolio. Diversification is key. We're mandated to have a broad diversification of assets and asset classes within the portfolio. And then I don't know if our portfolio is this screen. Can you move that down a little bit with performance on the very last? Okay, performance objectives. I just want to point out here that the performance objectives are over a long-term horizon. So we're looking over market cycles which are usually 3 to 5 years out. So we do a pretty good job on our portfolios, and we've only been here for maybe a year and a half now, and we've done pretty good staying close to the benchmark and beating it in most cases, and sometimes we won't. But over a long-term horizon, the idea is to have adequate performance within the portfolio. Constraints with recreation centers. The reason why you're not in any of those portfolios that we developed is you, as well as many clients that we have certain constraints. In the investment policy statement, we are mandated to target about almost 90% fixed income, and equities is around 10%. And then we have our U.S. and international mandate in there as well. There is an IPS restriction, and you see it on red here, of 20% in any individual holding, okay? And this is a passively managed portfolio. And so this does add just one more element that we have to think about when we are building portfolios. For example, some of those portfolios I showed you a moment ago on our efficient frontier do have over 20% in a single holding in some of our passive portfolios, and that's just because those passive investments are tracking an index, and the underlying securities within each investment is diversified. So this 20% holding does add a restriction within this portfolio. It's not a problem. We can work around it. All right. So just to summarize some of the constraints with recreation centers of Sun City is our mandate of how much bonds, how much stock we can have. Fixed income is bonds, equity is stock. Our 20% security restriction. The committee asked us to have very low cost, which we are doing. I think our expense ratio on the entire portfolio right now is 0.05%, so 5 basis points, which is pretty pretty inexpensive with the securities in the portfolio. And low risk. Okay, so when I showed you that initial graph of, we'd all like to have no risk and 8% return, we're not there, but we are lower on the risk spectrum. See if my red dot is working here. Okay, so this is kind of like that graph that I had showed you earlier. In fact, let me go back to that graph because it'll be easier to show this. This is recreation centers. This is where you would plot on the graph that I showed you earlier. Where is this portfolio relative? When we're trying to come up with the most efficient portfolios, how do we get the best bang for the amount of risk that we are willing to take? This is recreation centers portfolio. And let me just go back to really quick, and I'll just show you where this would plot on this graph so you can see it. You would be right about in here. Okay, so This is recreation centers, put you right here. So you're definitely on the lower risk spectrum, and our expected return on that would be right about in there, okay? And if we could move this down slightly. So how do we expect this portfolio to perform, especially after a year like 2022, which there really was nowhere to hide unless you were completely in energy or, just dumped everything into a certain treasury. I wouldn't recommend that, to have a concentrated position in any one asset class at any particular time. But what would we expect this portfolio to do? Historically speaking, when we take this portfolio and we model it with the return forecast, the way it's set up is over 75% of the time we should see positive returns on this portfolio. This is the last, let's see, we're going back to 1993. So we're going back 30 years. If we could go down just a teeny bit there so we can see that graph. I just want to point out how unusual 2022 was. In 2021, the Fed said, we're going to implement restrictive monetary policy. Interest rates are going up. Yes, everybody knew that. We all knew interest rates were going up. We all knew interest rates go up, bonds go down. Nobody knew the degree to which they would do it. Nobody knows this year, going forward, what sort of volatility we're going to see. It was an ugly year for sure, and but I just want to point out, over 30 years, if we took this same portfolio and looked over 30 years, over that 30-year horizon, at 27 times this portfolio was a positive portfolio. Okay, so I just kind of want to point out how unusual 2022 was. And yes, we can always look backward and say, this is what we should have done, this is where we could have been. But if we were in those right now going forward, that probably would not be a very good thing. So the best thing we could do is use modern portfolio theory, which we have, come up with the portfolio, stick with the portfolio, and stay with it. It works, and I'll show you just, this is a graph here that just shows some historical performance with a portfolio such as recreation centers. And if we can go down a little bit, I won't go through all the details here, but if you want to look at core fixed income, some of the ugliest moments that we've had, and no doubt 2022 was one of the ugliest ones for fixed income, and I'm pointing that one out because this portfolio is 90% fixed income. The recoveries, we always recover, and we're in a recovery mode here. Right now, we are finally in a place with fixed income where you can get a return on a portfolio. I'm actually very excited about this portfolio being 90% fixed income, lower volatility, historically speaking, but also being able to get a return on it. And I know we're already seeing those numbers come in, so I'm excited to see how the rest of this year plays out with the fixed income. All of our portfolios at CapTrust, it's nice to get back to basics and to see that our bonds, when we have a portfolio of bonds, we actually can get some cash flow on those assets. This is the entire portfolio here, and this is just kind of the end. I hope I didn't go too fast, but I want to make sure I leave some room for Q&A. And I'll just draw a little line right here, and you can see the yellow. The yellow, this little measure right here, we call it duration, and anything in yellow here, this is fixed income. And again, your portfolio is 90% fixed income or bonds. So I think it's important to talk about this. The numbers here will just specify how sensitive the portfolio would be to interest rates. In fourth quarter 2022, there was some monies that came into the portfolio, and I just want to point out that we put those into I-bonds, and that has worked out really, really well for the portfolio. They have very low duration, so less sensitivity, but they are throwing off some really nice yield into the portfolio at the moment. And I only point that out just to show the skill and expertise at CapTrust and what we do. So we build the portfolio, but we do have those discretionary decisions that we can make. so that we can maximize at any given point in time the returns with what we're seeing within the market. Again, the expense ratio is really low. We can look at duration on an entire portfolio basis, which is just under 5 there, which is just a little bit lower than what we would see on if I looked at the universe of bonds, we have something called the bond aggregate. It's a little bit less than that, which just means that in an interest rate environment that has gone up, this portfolio would perform a little bit better than what we would see with just the general universe of bonds. And then I'll only point out this very last slide here that breaks down the portfolio exposure. And I think it's just important to note when we get a lot of questions of, why are we almost 30% government, or why are we 40% corporate bonds? This breakdown right here is very close to, if I looked at the universe of bonds in, I've just took all the bonds that are available and I looked at the percentage, what's the percentage of municipal bonds in the universe of bonds? It's close. We're not, mirroring it exactly. We're tilted a little bit more towards corporate than what you would see, but it's very close. And again, the reason why we have these different portfolio allocations is just the mathematical models that we use, that we build to be able to maximize the return given the amount of risk that we've been mandated to try and stay within on a long-term basis. So the top one here is just your allocation within our fixed income sector. Again, I'm kind of focusing on that just because we have so much fixed income within this portfolio. And then we do have some equity sector weightings as well, but you'll see the very small percentage of the portfolio relative to the entire portfolio. So a bunch of supplemental stuff. I think I'll stop there, and I'm going to let Nathan do a lot of the Q&A and add any further thoughts that he may have.
So I want to make sure we leave enough time for questions, so we'll start there. Otherwise, I can fill it with just information if you like. But sorry.
I do have a question. What exactly does passive management mean?
Yeah, so passive would be, not making. We typically talk about it in the sense of the stock market, but not looking at earnings or expectations on a quarterly basis from an individual company and saying, I think Apple's going to have a good earnings quarter, so I'm going to own more Apple than I did before. It's really just reflecting the market and what the market owns. You pay an extra fee for somebody to do active management inside of a fund or a position, and that doesn't always pay off. And so generally, I think it was the expectation of the committee that hired us to keep costs low, and so we stick to more passive management to do that.
Is that why most of these funds have not been changed since 9/21?
Yeah, I mean, generally, we've made some changes in the fixed income space. Carol mentioned a couple new positions that we've added, some slight modifications in equity, but otherwise, yeah, I mean, I think if you are investing as according to the IPS with a long-term objective in mind, and you're not trying to time markets, you're going to build your asset allocation and you're going to stay committed to it. And it's intended to endure through challenging market environments. One of the things we'll mention when we're out here, I think in a couple of weeks, is we've seen nice recovery. I think at the worst point, the portfolio was down close to 11% from when we started managing it, and now it's only down about 5.5%. So we've already seen some recovery from market performance this year and tail end of last year.
So will this strategy ever recover all that was lost?
I fully expect it to.
Within what time period?
You're asking me to predict the future.
What does the model say?
Well, you're throwing off about close to 4% yield today. I mean, if markets didn't move at all, expect another 12 to 18 months. That being said, if interest rates continue to drop, that will bring back some of the valuation of the underlying fixed income. And the equity risk. Equities have contributed this year. The U.S. market's up about 7%, but we only have 10% in equities. So, historically, for clients, and I'm seeing in a broad sense across all portfolios, when the financial crisis happened, it was about an 18-month recovery period from bottom back to previous high. So, I wouldn't expect more than 3 years. Would be surprising.
Okay, do we have any other questions from the directors? Dick?
I do. Nathan, when I look at our fixed income, the sector weightings, there's three line items: agency-backed mortgage, government, and corporate bond. Would you explain to us what is inside, what that means, what an agency mortgage-backed government and corporate bonds are,
Yeah.
and why you're so heavily invested in them?
So, agency mortgage-backed securities, if you've ever watched some of the movies that have come out around the financial crisis, you've probably heard of, structures that package together loans. So a mortgage-backed security is really just a package of mortgages that have been loaned out to individuals who have homes. There's also commercial mortgage-backed securities, but this is specifically dealing with agency mortgage-backed, so it's residential. So those loans will be pooled together. The agency aspect of it means that they're guaranteed by a government agency, Federal Home Loan Bank, Fannie Mae, Freddie Mac. So there's a lot of protection there, similar to a government bond, just a slightly higher yield because of the nature of the mortgages and borrowers. I won't get into the big details, but they package them up. They split up risk categories and they sell those off. And so when you own an agency mortgage-backed security, you're really just buying a portfolio of mortgages being paid by homeowners across the country, guaranteed by the government. Government bonds would be your traditional kind of treasury bills, treasury bonds issued by the US government. And then corporate bonds are bonds issued by corporations. So McDonald's, Apple, Dow Chemical, whatever it might be, those are corporate bonds. And those can be a range in terms of risk levels. They can also be a range in terms of yield. The riskier companies with more debt on their balance sheet typically pay a higher yield. Within corporate bond, most of the time they're what are called investment grade. You can have non-investment grade, which would be more higher yielding as well. So there'd be a mix in there. Really, the objective here is to say, we have, as Carol pointed out, a reflection of the global or of the U.S. bond market. So this is kind of what the U.S. bond market looks like. I would tell you it's probably weighted a little bit more government, a little less corporate, but not a lot. But really a reflection of the entirety of the bond market. And again, the objective being, let's try to get the most yield we can for an appropriate amount of risk.
Thank you.
Nathan, during the interview process that you had with the group that looked at the various other folks that did this, you were obviously told about our policy FY12, the investment of asset association funds.
Not recalling off the top of my head. I'm sure we were, yes.
Well, here's what it says, is that the primary objective of this investment program is a conservative and prudent approach to the management of the assets in its investment portfolios. The specific goals shall target the preservation of capital, liquidity, and rate of return in that order. Explain to me how this portfolio does that.
Yeah, well, I brought up this graph right here. As Carol talked about, our expectation based on what we knew at the time was that the 95th percentile, which is a 1 in 40-year occurrence, should be down about 1.25%. So 2022 was a massive outlier, and I don't think we were unique in having that affect our portfolios. I mentioned to Dick on a call a couple days ago, if you look at what's happening in the banking sector today, it's the same problem. The banking sector gets deposits from individuals. They have to pay a rate of interest on those deposits. Unless they want to perpetually lose money, they need to invest those deposits and try to make a return. Sometimes their investments are loans, which pay a higher rate of interest than what they're paying to depositors. In other cases, they're investing those funds. And that has historically been in high quality, very safe securities like treasuries. But if you look, there's been lots of reports. I mean, You heard about Silicon Valley Bank, you heard about Signature Bank. Every bank has a portfolio of investments that is currently undervalued because of the rate change in interest rates. Because at the time that they received deposits, you know, they said, if we're paying 10 basis points, we got to make at least 1% or 1.5%. So they're buying, you know, 7-10-year treasury bonds to try to earn that yield. And now because of the change in interest rates, those bonds are worth a lot less than they were. They're still paying interest. They're still completely safe. But if you try to sell them in the market today, you're going to experience a loss. And so that's been the experience of everybody in the market, is that the increase in interest rates by the Federal Reserve had a material impact on what you expect from safe securities. And that's been the experience here. That being said, we fully expect recovery. We've started to see that. The Federal Reserve came out and said, you know, we're going to treat all of these securities as though they're valued at par because there's nothing wrong with them. They're providing that guaranteed backing because they know if you hold those securities until they mature, you're going to get all your money back. So, you know, what can I say to the fact that the priority being preservation of capital, and we experience the, you know, once in a lifetime market environment? I don't think anybody anticipated that. But we invested the portfolio prudently. We are fiduciaries. We did what we think was appropriate. And I do believe if you have a long-term perspective on this, that you will see recovery in a reasonable amount of time.
I have one in particular question, and that is looking at the statements that we get from CapTrust every month. If you go on a month-to-month basis, the valuation swings $700,000 to $800,000 plus or minus. Why does that happen?
Well, I'd probably have to come back to you with an answer on that, because we have gotten some inflows, some
No,
contributions
this is
to the
past the
portfolio.
inflow.
Okay. Yeah, I mean, it's been an extremely volatile time, and it's all been driven by the change in interest rates. I think we showed in the last meeting, this is the fastest path to higher interest rates in history. I think if you look at those, if you were to compare those statements from last year to this next 12 months, it'll be a very different story, because you're just not going to see the change in interest rates that you saw to the same extent. We built the portfolio, and the finance committee set the asset allocation with the expectation that fixed income would be very safe, and it's been the most volatile that it's been in history. So that's had an impact for sure.
So you built this portfolio in the latter part of 2021?
Correct.
Around September.
Yep.
If you were to build it today, would it look different?
We would still be within the IPS constraints of the 90-10, and no, it wouldn't. It would be, it might have a little bit more shorter term because the yield curve is inverted. So we're getting paid more. That's why we added the short-term bond positions, because we're getting paid more for owning 1- and 2-year bonds as opposed to 7- and 10-year bonds. But when we built this, you were getting nothing for short-term, zero.
But the landscape certainly has changed since September 2001, right?
The landscape, yeah, of the market environment has changed since 2021. We would still own what we own in equities. I think fixed income, we would just be a little bit shorter duration. We've done that within the portfolio. So we were much closer to market duration when we built it. And as the market has changed and you're not getting paid for taking long-term risk, we have shortened duration. But if you came to us today and said we want a 90-10 portfolio, it would look a lot like what you have today. I think what you're saying is maybe not accurate, in that this is not the exact same portfolio we started with in 2021. It is from an asset allocation standpoint, but not from the underlying positions.
Well, I'd like to explore that further with you, because when I look at the various assets of the funds that are involved, none of them have changed since September 21. So if you're changing positions, I don't see where it's reflected.
Okay, well, we can come back to you with a comparison and a history of changes that have been made.
I think that'd be helpful.
Okay.
All right, any other questions? Harry?
I've got several. And I went back and analyzed the monies we put in at the beginning, which was $30,755,000. We had an investment come in December of 22, which would have been our 21 earnings, of $3,200,000. our earnings of 22-23, or that came in December of 23, 21-22, 40, no, wrong. December of 22 was 30, so we had 33,991,000. And we had investment earnings to date of 475,000, according to your statements. So we're at 34,466. Our value at February 23 is 30,733,000. So since the beginning, we're down 3.7 million, which is about a 10.8% loss. Do those figures sound right?
Yeah, I mean, I have through the end of March 31st, which you don't have yet, but through the end of 2022, we were down, I think, around 10%.
Okay. Now, the statement was made that this all basically happened in 22, which a lot of it did. But I look at February of 2023, and according to the statements I got, the loss in February was 671,000. The account in January read a positive of 75,000, which I assume had been an increase in values. So that means in the month of February, we lost 746,000 in 1923 or 2023. So that is still happening today, right?
So I don't have the month-by-month statements. Again, this is something we can come back to and address month by month. I can tell you in the first quarter of 2023, the portfolio has gained $944,000. That's not a January, February, March, that's all three together. So I'd have to come back to you on the month.
I don't have the March numbers. Okay, I'd like to go back to...
Can I finish? I'll address this, Pete. I manage a lot of the this portfolio in the sense of representing the association from staff perspective, and of course they manage it. So you're referencing the 10% like it's a loss. As he mentioned, that we have a much longer horizon on that. If you go back and evaluate what he's saying was about a 10% within the portfolio loss in 2022. It's reflected in the valuation. What was there? I mean, you're making it sound like there's a surprise there. It was 34 million with the investment, and yes, there was a $3 million decline. Go back to even further though, what seems to be forgotten was that same portfolio in the 3 years leading up to it had almost $6 million of backtail or appreciation. So you have to look on a longer term basis to evaluate that, you know, is this a wise investment or not? Nobody was coming in here and saying, oh my God, when it was, you know, having $1.5 million, $2 million valuation improvements. Going to the second part of it, we oftentimes just look at valuation. Don't forget that when it was about a year and a half ago, it was earning 0.5 if you were lucky. We were earning about 300,000 annually on that yield on that. Now it's slowly appreciating every month as we're now buying. Every month the mutual funds are buying, you know, 4%, 5% bonds, and slowly we're appreciating. Now we're earning almost. I think I just was ready to propose the entry for March, and it was almost 80,000, 75,000 a month. So we're on a trend line now of almost $500,000 more of earnings per year. And that's going to sustain itself because if it takes that long to rise, then if interest rates come down, you'll see the bond portfolio recover, which is probably likely, as she was alluding to, is I don't think there's many people right now that think the Fed's going to go much higher than 5. And that's like, they're already debating that. And so if that sustains itself or a recession hits, what do? They lower interest rates to spur the economy. Then the fixed income does well. All the while, you're still earning almost 4% now on that portfolio, which is earning $900,000 annually.
When you say 4%, are you talking about the treasury bonds that you have invested in?
All across the spectrum. There's corporate bonds earning almost 5. There's
At the
the
portfolio, entire
government
portfolio
agencies that are earning 4, T-bills are earning 4. So that there in the yellow column in the middle reflects the yield that's currently being rendered on that. So that 31 million that we're about right now is earning, like I said, about $900,000 annually. Our modeling for our reserve fund, FFP percent was using about $600,000-700,000 at the beginning of the year. So as that adds almost 150-200,000 annually, will serve to strengthen the FFP percent. But going to your point on the valuation, we saw the T-bills, which at least or the Treasury, 10-year Treasury, which I usually look at for like when I see that move up or down, it usually means our portfolio is going to move with it. And it was like 4% just a month and a half ago. But now, as the expectation is maybe the feds are going to cool off their investment, then the longer term is coming down. And so they're down to about 3.4 as of this morning. So yeah, you're going to get appreciation in that time. And as he alluded to, we can get $600,000, $700,000, $800,000 swings. 4 of the last 6 months have been in the positive, so you're highlighting 1 month when there was a fear that inflation was creeping back in. Is the Fed gonna keep raising? Well, 10-year goes along with it. And when that did that, we had the $600,000 decline. Fast forward to the current month or the month of March, 700,000 favorable. So, you got a $34 million portfolio. It only takes 1 or 2% to move that, by 600 grand.
Well, that leads to my next question. Put up FY12, please. And go to 2.0, the purpose, which Tim has read, 2.1, the goals and objective. 2.11, preservation of capital is the foremost objective of the investment portfolio. When I Google preservation of capital, it states investing where capital is not at risk.
Can you scroll down a little bit?
And I think we're violating this policy in that the capital has been at risk because it's down $3.7 million.
So you have goals and objectives, and we can come back and I think Carol highlighted in the beginning of the presentation some of the other objectives to exceed the rate of inflation, to deliver a return over a long-term period of time. If preservation of capital is the sole objective, you should be in cash.
Well, and this is what it says. If you read it in that order, preservation of capital, liquidity, and rate of return. Rate of return is the third item.
Yeah, and again, when we were hired in September of 2021, we could not deliver preservation of capital and rate of return. There was no return on cash. Today, we can get 4% in cash, 4.5% in cash. So at the time, not knowing what was to come, we invested with the objective of both preservation of capital. I showed you the distribution curve. I won't go back to it. The expectation was very low risk and some return. I think at the time we were projecting 3% for the entire portfolio, and now it's closer to 4%. So without a crystal ball, I don't know how we would have avoided the environment we're in and invested prudently, but we can certainly take a different path at this point because the market has changed.
Well, I think, I'm going to speak for the board here. I think our concern, one, is that for me personally, this is the first time I've ever heard passively managed. Okay, so my question is, have you been given the right direction? Have you been given the right priorities to do? And would it look different if we realign the priorities?
So passively managed refers to the underlying investment securities, not our management. We are constantly evaluating the portfolio and the market environment and making adjustments as such, but We're not market timers. So we have adjusted duration because the yield curve is inverted. That's been an active change on our part. I think if you came to us again and said we want 90% fixed income, 10% equities, the portfolio would look similar to how it does today. What I'm hearing now is a much greater emphasis on preservation of capital. You know, and hindsight is 2020. You know, had we shown you all of the data of fixed income 2 years ago, you wouldn't have expected the type of risk that we've seen.
Well, 2022 is over. I mean, I'm not looking past, I'm looking forward. Is this the right place to be going forward? And I
Yes.
think that's a legitimate question.
Yes.
Yes, this is the right place?
Yes, I believe the portfolio as allocated today is appropriate. If you said we do not want to lose a single dollar of money, that's not what this entire document says, we would make changes. If you said we never want to see a market decline impacting our portfolio again, no, this is not the right portfolio. But if you say we want to preserve capital, so very low risk, that's how it's allocated. We want to earn a return. We want to beat inflation, which is still at 5% a year. Then yes, this is how we would build the portfolio.
Okay. Any other questions?
Just a couple of things. Our compatriots around us, and the two that I know very well is Sun City and Grand. And all three of them are extremely different. So a real quick synopsis. Over at Sun City, the way I understand it, for the most part, they are in a cash position. They've been that way for a long time. They just mostly in CDs and in rising risk environments. If they were out 3, 4, 5 years, they are holding those CDs and watching them not lose valuation, but their interest rate isn't going to even keeping up with inflation. But at the end of the year, this is going into our world a little bit, but at the end of the year, they have to go and actually value those and reflect it on the income statement as what's the true valuation. Now, CDs are, considered cash, so they don't get that. Now you kick over to Grand. For the most part, they go after a little bit of yield and a shorter maturity, so they buy a lot of bonds. They actually go into the world of buying specific, stock picking, or bond picking, which you look at our IPS up there, or our policy, we're very much stay away from any picking. Follow index, get in ETFs. That last part, though, is the key. If they bought a 3-year bond, and I think they do with Harley Davidson, for example, and it was 1% for a 3-year bond, they're on their balance sheet, they're going to show $1 million bond and earning 1% a year. So they get their dividends quarterly or annually, whatever, or interest. But when they get to the end of the year, I've talked to the CFO, they actually have to go to an outside entity and value that bond as what it is. It's not $1 million anymore. If you went out on the market and it was 1%, no one's going to pay you $1 million. They're going to discount it. And so they reflect that. We do it real time. So instead of buying individual bonds or CDs, we're buying very high grade bonds and a small amount of equity exposure. And when we do that, we buy them in exchange trade funds or mutual funds, and every day at midnight, those are valued. In fact, the equities are every minute. So we're reflecting on our income statement, those valuation changes, Harry, for example, instead of waiting for one fixed time at the end of the year. We're doing it real time, so we're valuing. We're not losing the money, we're valuating it at what it is on the market. But we don't tap into those funds. We have to look out 5, 6, 7 years. That's what we do in our FFB. And we don't even put any market changes in there, but what I was saying earlier is you do put in $600,000, $700,000, $800,000 of earnings, which is up 50, 60, 70% from where we were a year ago. And then lastly, I do want to point out, I think there was a statement about are they ever changing the position within the portfolio? They have a lot of clients. And so I wouldn't expect them to know the detail, but probably every 6 months, we're seeing some big, changes within the portfolio. They're moving to, as he mentioned, shorter duration. That was a perfect move when they did it. They are applying the annual investment that we do as part of our annual transfer from the reserve fund, from the operating into the reserve fund. They put that $3 million and earning 5%. Very short duration, very smart. But I would lastly say, going back to what he said, is that most people right now would think that interest rates are not going to go much higher by the Fed. So if you wanted to capitulate, so to speak, and value everything and just dump it in T-bills right now, you're going to be locked in at 4%. But everything you own would have much greater value if interest rates come down, as they have been, on the longer term T-bills. The valuation's probably poised to have millions of dollars recovery. And you want to walk away from that? I just don't think that's wise.
Okay, we need to wrap this up. If there are any other comments quickly, Harry?
Yes, this is entirely different. The funds, the ETF funds, I see, because of the 20% limitations, I see you're in 3 ETF funds.
We actually own 5.
5? Okay. Each fund, what's the difference in the funds? Are most funds aren't they invested in the same type, same assets?
So if you look at this list, so the first ETF, IGSB, iShares 1 to 5 year investment grade corporate bonds. So those are corporate bonds with maturities somewhere between 1 and 5 years. iShares MBS ETF is specifically owning mortgage-backed securities, which we talked about before. iShares Core US Aggregate Bond, AGG, that is a replication of the US bond market. LQD is investment grade corporate bonds as well, but without the 5-year limitation. And then the last two have focused on maturities in 23 and 24. So what I can tell you is that probably the 3 in the middle, FXNAX, which is a mutual fund, SWAGX, and AGG have a lot of overlap. If we didn't have the 20% restriction, we probably wouldn't own all 3 of those.
And when you invest in that fund, is it like buying a share of stock in a mutual fund?
An ETF is nearly identical to a mutual fund.
Okay, so if you're buying a share of stock, is that not an equity?
No, it's not an equity. The underlying holdings are all fixed income. An ETF is the difference between an ETF and a mutual fund is that an ETF can trade on a daily or on a throughout the day. A mutual fund settles at the end of the day, but the underlying holdings are very similar.
Okay, I was just because to me it feels like an equity. I mean, if you're buying an interest in a mutual fund, you're buying a share of all that, but you're buying a share of the mutual fund, which is an ownership in it, which is an equity. And so an ETF is different than that, is what you're saying.
An ETF owns, you're buying an interest in the underlying positions in the ETF, but they're both funds. They hold positions, and as an investor in them, you own a fraction of all of those positions. It's from a experiential standpoint, it's identical between a mutual fund and an ETF. The main difference is if you go to sell a mutual fund, you put your sell order in, and at the end of the day, they'll value it and give you your money based on the value at the end of the day. With an ETF, you can go in at 11:35 a.m. and sell it, and it'll sell immediately. That's it. There's tax differences which are irrelevant to this portfolio, but that's generally
But that almost sounds like an equity to me.
It trades like an equity, but does not have volatility like an equity because the underlying holdings are bonds.
Bonds, yeah. But it's still, to get your ownership, it's like buying a share of stock.
I'm not sure. Yeah, it's similar, but
okay.
We can take that up individually later, but thank you, Nate and Carol. Thank you very much. All right, moving on. Yes.
I think just as, not for them, but for the board, when we looked at the FA, whatever that number was, it was just up, oh, I have it on, sorry. Could they put it back up again?
FY12.
Yeah. Yeah, I'm sorry, the purpose, if you look at 2.0, there's a purpose up there for the board, in my opinion.
Yes, we're fiduciaries.
Okay, so that means that we should be doing that first part, then giving it to them for goals and objectives. I don't see that we did that ever as a board.
There's another policy that says that we have a management company that does it for us.
Well, then that doesn't say that, though. That says treasurer and chief financial officer. That's what I'm trying to get at. I don't recall as a board that we did any of that purpose. That's all I'm making the comment. I was like, you're asking
Right.
whether or not, I think we need to look at whether that's what we should be doing or not doing, is all I'm
Right.
asking.
There's another policy that says we will use a manager, financial manager. Okay. All right, moving on to 3.02, Property Committee Recommendation Decision. The Rec Center parking lot security cameras facility management. Russ Boston?
No, I'm going to do it.
Oh, are you? Okay, Roberta, go ahead.
Yeah. So the Properties Committee recommends a 1-year trial of one leased portable camera unit plus the installation of fixed cameras on buildings as facility manager Russ Boston sees fit. As a side note, staff has indicated that allowances in the current year budget will cover all the expenses. So what we're recommending, do you have the slides? Yeah. Yeah. If you look at the least powered security camera, we're recommending that we do a 1-year lease on one of those cameras. The suggestion was to put it up in Palm Ridge because of all the break-ins and stolen golf carts from that area. But we're going to let staff determine where it really should go. Currently, we're also recommending that the single camera that's currently on the administration building, that additional cameras be put on Johnson on the building where it's appropriate. One of the limitations we have is certain positions of the building, it doesn't work to see far enough out in the parking lot. The other is trees. We have to trim a lot of trees to make the cameras be able to see out into the parking lot. So if we have any additional questions, Russ is here to help us with that.
Are there any questions from the directors? Ann?
Yeah. What is our total annual cost for this, and are we paying for it monthly, or are we paying it in advance for a year? The cameras are,
So the building cameras would be a small amount right up front. You pay for the items, they get installed, and we're done. On the big unit, it's per month. I don't know if we could set it up with them per month, or we can do it all at one lump. I'm not sure. So once this has been approved, all these figures are based off of one company. So I have yet to go out to other companies. I will go out to at least 3. And I will answer all those questions when that time comes.
Sure, go ahead.
so is any of this included in the budget for next fiscal year, 23-24?
No, because we're just now making decisions. So none of that has been put into the budget at this time.
So that still needs to be put into the budget if it's approved.
It's coming out of allowance for this year, I believe.
Okay, what about next year?
So we haven't decided we're going to go any further. So we're going to do this for 1 year, reevaluate it to see if this is something that even works, which is why we're not doing any purchases. It
But
gives
it
us
seems to me
options.
like we're going to have more. I mean, I know we can cover a couple of months in this current year, Next year, where would that come out of the budget?
It would probably come out of allowances again.
Okay.
All right, Harry?
I heard there was an incident, and did the one camera, the $2,900 camera that's up on R.H. Johnson, did that work? Did it show what happened?
Yes and no.
Yes and
So
no.
yes, yes, I saw him. I figured out what he was doing. However, where he comes in from the side, we never see his license plate, but we do know what the vehicle is, what color it is. It has been turned over to the sheriff. They have the ability to enhance stuff that we cannot. So we have not heard anything as of yet as to what they have found or come up with anything so far. Mhm.
Okay. All right, as a recommendation, this doesn't require any board action, so we'll move on to 3.03. Sports Pavilion update, Restaurant Bar Concept Subcommittee, Sports Pavilion Subcommittee, Lisa Vines. And we're gonna move that till later until Lisa's here to provide that. All right, approval request, new RR&P format. Charter Club Chairman Jack Leary.
Okay, thank you, Tim. You may recall that I had these sent to you last fall, and I realized that I had gotten a little bit ahead of myself as I had not run this past the Chartered Clubs Committee. So since then, I have done that. What you have in front of you is simply the existing RR&Ps with a different format where each paragraph is numbered and it's easier to reference. So what I'm looking for here is agreement on the new layout, the new format, so that when we begin to look at RR&Ps going forward, it'll be a heck of a lot easier for us to edit and change and to review the format. So that's what I'm looking for.
All right, are there any questions about the format for Jack? Sharon?
Just one. Jack and I spoke earlier before the meeting. I just want to make sure that whatever we're laying out is what's appropriate for the Arizona Statute 33, so we're not putting anything in here that shouldn't be in it. I mean, or that contradicts what the state says at this time.
We're talking
That's
right
all.
now just about the format that he has.
I know, but is the format correct? That's all I'm asking. I just don't know enough about the Arizona statute and what it reads as to whether or not we can even have certain items in it. That's why I'm just asking that we look at it from that perspective
Sure,
first
if
before
you
we do
can
that.
give us a citation, we'll be glad to look at it. All right. Do I have consensus for Jack to move forward with the format for this R&P? Yes, yes. Anyone opposed? All right. Jack,
Thank you.
have consensus.
Thank you. The next one that I've got, I want to move on.
Sure, go ahead. 3.05.
Okay, yeah, 3.05. You have the report that was prepared by the Subcommittee for the Tournaments, Leagues, and Special Events. It was presented to the Chartered Clubs Committee on March 28th, I believe it was. And at that point, the Chartered Clubs Committee approved a recommendation to move all of the recommendations in the report forward to the governing board. So what I would like is, I'm assuming that you have all read these, so that based upon that, I would like to get consensus to, would allow the Chartered Clubs Committee can move forward on the recommendations from that report.
Okay, Jack, several of the recommendations require policy changes, particularly Section 7, Section 9. Several of the sections refer to changing the RR&Ps. There's some process changes, there's some form changes in here, and there's also a recommendation for monitoring stations. And what I'm going to ask for is consensus to move the report forward, and we need to reply back on what the policy changes would be, how you're going to change the RR&Ps, and the process changes, and working with operations to change the agreements and requests.
Okay, so you, so you want that now?
No. Obviously, there's a lot of work to be done to fulfill all of
Clearly,
these
yes.
recommendations. So I'm going to ask for consensus to accept the report and we'll ask you to report back later on how you're going to implement the recommendations.
Okay.
Okay? A question? Go ahead, Dick.
Jack, I'm a little confused. When I read this, and specifically I want to talk about Appendix 14G, I don't understand this. You know, what it appears to me is this is an informational schedule. I mean, this doesn't, I just don't know what the purpose of it is.
Let me scroll down to 14G.
Yeah, it's the one.
Or what is it, Appendix G?
Yes. It's the APPL, Arizona Pickleball Players League. Winter schedule.
So the purpose of that is a reference, there's a reference to, and I've got my committee members here to help me out, but that's a reference to a couple of the issues that were uncovered in that there are residents who are committing facilities owned by the association for their own personal use. They're in effect opening up our facilities to the public.
So this is really just a demonstration. I mean,
Exactly.
we're not endorsing anything with
Oh,
this.
no.
I just wanted to clarify that point.
Yeah,
Thank-
you know,
thank-
not at
Thank
all.
you very much.
In fact, there needs to be another point that's clarified on this too. It shows that there are some courts being scheduled at Liberty and Sands. And my information says that it shows up on here, but those courts were never actually scheduled. So we need to confirm or confirm that or repudiate that.
So they were never confirmed in whatever what's it called?
There was never any courts actually reserved that would comply with these two statements down here.
So we don't know if they were actually used or
Right.
not. Okay, we'll have to find that out.
Okay. All right, so we do have consensus to accept Jack's report and wait for his actions on the recommendations. Okay? Sharon?
Yes, but Jack also said this wasn't complete, so he's looking at other things besides these, correct?
Well, the
Like,
reports
this is not
that-
all the clubs, this is just the ones you found.
These are the ones we found, but yes, if there are others, we will uncover them.
Okay, thanks.
So is that a yes, Dick?
Yes.
Yes.
Harry? Yes.
Okay, golf committee met?
No, wait a
yet?
minute, Harry, do you?
No.
We need consensus on Jack to accept this report, Jack. Okay, Jack, you have consensus. We've
Thank you.
accepted the report, and there are several things that require action items to implement before the recommendations are implemented. Okay, thank you.
Tim, could I ask for a clarification on this?
Sure.
I guess I'm a little bit lost on this, so will this come back up again?
Yes.
Will it come back into the governing board?
Yes,
Well, we'll be able to discuss it and get community input on this as well?
yes,
Thank you, I'm done.
yes. Some of the recommendations require policy changes that will have to be handled separately. Several of them require changing the RR&Ps, which the board will have to approve. There are several that are process changes in how we do things, how operations does some things. And there's some forms as far as reciprocity requests and agreements, that sort of thing, that need to be redone and approved. Okay? And then monitoring stations is a budgetary item that will need to be addressed at some later date. Okay? All right, let's see. Proposed 23-24 budget presentation updates, and Cliff will ask you to be as brief as possible.
Okay, it's still morning, so good morning, everyone. First of all, I just want to give an update here, and before I start, I just want to thank everybody who's been involved with this process, the community, certainly this board, BNF, the staff. You know, it's coming together. We're coming down the home stretch, and I'm really excited about it. So, that being said, we'll get started. Just want to remind everybody, top 10, according to Retire Better Now. So we talk about the goals, the budget goals that we have, and to summarize those, it's to keep this place looking nice, okay? Yes, sir. You want to do those first? Sure thing.
Okay, we had our golf meeting yesterday, committee meeting, and there were some changes made from the meeting we had in February or in March. And we had approval from the committee, a recommendation of total approval unanimous to decrease the golf rounds from 326 to 315. Member rate increases of $2 prime time, $2 twilight, $2 super twilight, October through May, $1 during the summer for members. Member guest rates to increase $3 prime time, $1 twilight. Public rate increase $5 prime time, $3 twilight, $1 super twilight. No changes in summer rates. Range ball increase at $1 at the machines. No changes for members only using the discount card. And a golf cart rental decrease of $2 per cart at all times. And it was unanimously approved by the golf committee.
Thank you, Harry. As a recommendation, that doesn't require any other board action. So moving down to Dick Rhodes, 2023-24 annual dues increase.
Thanks, Tim. I'm going to make this very brief. We had a very lengthy Budget and Finance Committee meeting, and we spent a good deal of time on all of the different aspects. We talked about the CPI. We talked about almost all of the factors that influence the budget and what the overall dues would end up being. And it really boiled down to two things. One of which is we made kind of a blanket recommendation that we felt the proposed member dues should be $540 a month, and which would be inclusive and part of that. Excuse me, a year. Was not a month. I wondered why everybody was quiet. That's what we paid. That's what we paid in Kansas. So $540 a year, and in that included wrapped in their credit card fees and such. And then the other thing that we proposed is that we were okay with, we felt that it was appropriate to increase our APFs to $5,000. So the first proposal was from 42 to 47, and then this one jumps that up another $300 to $5,000.
Okay.
So
Thank you, Dick. As recommendations, it doesn't require any of the board action. Cliff, it's all you now, buddy.
Okay, so the recommendations that were just discussed are incorporated into this budget, and attached to this agenda item is the budget packet. I encourage you to go there, look at the categories, look at the divisions, look at the details behind this budget. I'm going to briefly go over some of the changes since last presented, and then the overall proposals and assumptions for this budget. So again, top 10, United States, something to be proud of. You live in a great place. I'm fortunate to be working here. So taking a look at the top 10, here we rank with our current dues, and just want to remind everybody that we are here and we are providing a great experience for a very good value. That being said, when we talk about dues, there's a ceiling that we don't go over, and that's 15%. This is a bylaw. It's 4.20.3, and it establishes that dues cannot increase year over year more than 15%. When we look at historical dues from 1993 forward, our average dues increase has been 5.4%. So when we look back to 1993 for 30 years, 5.4% has been our average increase percent year over year. We go back 20 years, And this chart, we've presented this before, but it's to show that we're consistently above the inflation rate when it comes to dues. And I just want to show some historical context there. And then if you look at the last 3 to 4 year window, you can see we're trending in, we trended below that. And we've got a pretty sizable gap right now in when it comes to the relationship between dues and CPI, which is an index that we use a lot when we put a lot of, I would say we put a lot of investment into the CPI because we feel that's a great indicator for us when we're looking at our budget. So, taking the last 20 years, the average dues increase year over year has been 6.1%. So since 2000, 6.1% on average has been our dues increase percent year over year. Again, we talk about CPI, we talk about inflation. We use that because that is impacting all of the supplies and everything that that we purchase to operate this facility, as well as our employees, their cost of living, and what we have to do with their pay rates. This is all kind of tied together when it comes to budgeting expenses for this operation. And then you can see the historical averages. Basically, since 1914, the average inflation rate has been a little over 3%, and the last 2 years, it's been over 6%. We also look at our surrounding communities. We look at them just to see, what they're doing as well, and you can see here that an average of over 7% at all of these communities in dues increases from last year to their proposed budgeted year. All right, so we talked about some changes. We talked about the recommendations, and a couple of changes I want to highlight on the expense side in this budget are we had a change in our outside services. We're budgeting for scheduling software, an upgrade to our scheduling software, as well as we got our estimates in for the renewals on our property and liability insurance, and those came in a little higher at 7%. We originally had 5% increase in the budget, so we had to make a change for that. But both of those are reflected in this budget, and if you want to get some details on the property and liability, we'll be presenting that next week at BNF. On the revenue side, again, the recommendation on the dues increase, 6.1% increase to 540. And this is to help us close the gap on inflation. When I say close the gap on inflation, it really is to help us cover our costs. Not only our cost to operate, but inflation impacts that the fully funded balance, the reserve study, everything. So this is to help get us back in line when it comes to that. And it's a $31 increase. It's about $2.58 a month, not $5.40, Dick. So APFs, we talked about the $5,000. We feel like that still puts us, we're still on the market. I believe Grand's APF is $5,000. So we're still on the market with APFs at a $5,000 rate. All that goes into the reserve fund and doesn't impact any of our existing members per se, but it does help us bolster that fund. So that's the recommendation. And then we're going to continue to treat credit card fees as a cost of doing business here. And that's what we're going to do, and that's reflected in this budget. We talked about golf rounds. There's a lot of consternation about the rounds that we initially budgeted, and taking a look at the last 3 months from when we first started budgeting to what's actually happened here, we've had 43 events that have impacted golf. And this is real money for us, because when people aren't golfing and people aren't on the course, that impacts our revenue. So we have to take that into account when we put together the budget. So we've done that, and that was the reason for the adjustment. And this is just some context behind that. So 315,000 rounds. And then we had a lot of discussion about our rates, and great discussion. And, we provide a great experience on our golf courses here, but we do compete in the market. So taking a look at that, we were really getting at a level with the original recommendation where it was just getting a little too steep. So we decided to kind of spread that around a little bit better, as well as create a rate for our member guests versus the public golfers. And that was the recommendation on the fees, and they have already been proposed, and here they are presented. Cart rentals also, that all ties in together with the total rate. So that was the reason for the decrease to 16, to make sure we keep that overall rate within a bandwidth that keeps us competitive in the market. And then range balls, I just want to reiterate, members only will continue to be able to have range balls at the current rate that they have them. So you can as long as you purchase a range card. Okay, and then that won't be available at a discount for our public golfers, but they still are getting a good value at 3 and 6. Okay, we have one capital change, and this came about. Well, we recently purchased a server. There was some conversations about what we would do with the old server and how we would utilize that, and we decided that we would utilize it in a way where it makes us more secure and gives us proper backup and mirroring and reporting. I'm going to TO it to Katie to drill into this a little bit more, but the impact to the budget is $89,000, and Katie's going to give a little context behind these SQL licenses that we need for this server.
Okay, yeah, thank you. So we actually have the new server in-house and ready to go. It's a 2023 server, and it's going to become our primary TEI server. TEI is the software that runs membership, runs golf, all the data in there, as well as for the facilities. But we don't have the SQL licensing. So the SQL licensing is quite high at like $89,000, but that's due to several things. The primary one is a change from a per user licensing model that we had prior to TEI to now a per core licensing. So how many cores are on the server is what you're getting charged on. We had to make that switch because of all these additional, you can see on there, post 2012 additions, integrations, things that are touching this TEI server, which expanded the number of users. So the Cal licensing model just didn't work anymore. And then additionally, as we make this change to the new primary server, we'll take the old server, turn it into a mirror. That mirror allows us to live mirror all the data coming in through golf courses, rec centers, so that if the primary went down, we wouldn't lose an entire day's worth of data, because most backups are overnight. If it went down at 5 o'clock at night, you'd lose all those transactions. But with the mirrored server, we're capturing that throughout the day, so if the primary went down, we just switch over to the mirror. In the past, we didn't put SQL on that mirror because no users were actually touching it. It was just warehousing the data. But with this change, we hope to build a reporting server on the mirror. And when we do that, back office users pulling heavy data, the finance team, they'll need licensing as well. So we're looking at upgrading the licensing on the primary, adding licensing to the mirror. Like I said, the current server is in-house, so that's not a cost. We just need to get it up and running with the licensing. So if we jump to the last slide, Terry, not to bore everyone, but this is just a kind of snapshot, very simplified, of that portion of our network. And the thing I want to draw your attention to is the orange stars are everything that we had prior to the move to TEI in some format or another. But you can see the little numbers in there. So let's say down near above Ann, they've got 14 in the star. That represents the 14 remote golf course users that used to touch the TEI server. That has ballooned into like 54 today because we've got facilities on there, we have play profiles on there, we have a whole lot more users, snack bar, Lizard Acres. But you can see just how many more things are connected to that TEI primary server over there to the left of the SD-WAN cloud. I'm happy to go into more detail, but I don't want to bore anyone. So the point is, we've grown from about a handful of 25 to 30 users to more than 140 touching that server. We needed to build a bigger server, and we want to get this reporting server. So we're asking for $89,100 for the SQL licensing.
I do have a question, Katie. My understanding now is Golf maintains a separate database on users that they send out.
So that isn't even on this network. That's part of MailChimp. So when you do email newsletters like that, you have certain federal laws, so you're not spamming people. So people will opt into that newsletter, and Golf will send them whatever news announcements they have. And then we have one for the rec centers and one for events. We also have them for chartered clubs. That has nothing to do with this.
Okay, thank you. Any other questions for Katie? Okay, Katie, thank you.
Thank you so much.
Thank you, Katie. Okay, so the final impact on this budget to the fully funded balance is this operating budget puts $1 million into our reserve fund. It's right there on that reserve fund allocation line, as well as almost $5.1 million from APFs into our reserve fund, almost $700,000 in investment income, and then those funds will pay for the roughly $6.2 million in capital spend, and at the end of the year, projecting the reserve fund to be at roughly $26.5 million at a 49% FFB percent. And then by year, projecting out to 28, we'll be at roughly 49% with a $28 million reserve fund balance based on the modeling assumptions. With the proposed fees, here's where we rank in top 10, and we still feel like that there's a great value here and a great product. So that's it, Mr. Hurley.
Okay, thank you, Cliff. Cliff, one question. With the adjustments that were made by the committee recommendations to lower the golf rounds and to lower the APFs that has been incorporated earlier on, if the APFs go up, and if the golf rounds go up, where does that money go?
That goes right into the reserve fund.
Okay.
Absolutely. So yes, we feel good about the $1 million, but there's a great opportunity out there, a possibility that it may be 1.2, 1.3, or
Okay.
maybe even 1.5, who knows?
Okay,
But yeah.
good. Does anyone else have any questions for Cliff? Harry?
Cliff, I assume the $1 million is going to be shown as a line item expense, so if the budget comes to zero?
Yes, what it'll show as is down in the capital section, there'll be a line item right there for it, and it will be called out specifically. Yes, sir. You're
Okay,
welcome.
Thank you. Any other questions? Okay. Jack, I'm sorry.
Yeah. How much more do we expect this budget to change before May 30th?
I would say not much, if something comes in the form of a recommendation, but yeah, in terms of capital, I mean, we have this one $89,000 capital add, and you all will be doing the recommendation next meeting on the capital items. But as far as the operating budget goes, some of the percent changes and the year-over-year changes will change because I'm going to update it for March. But other than that, as far as what's being recommended and proposed, we shouldn't see too many changes.
Okay, perfect. Thank you.
Yes, sir.
Okay, thank you, Cliff. Our next item is 311. It's the budget development. No, I'm sorry. It's 310. New capital R&R line items pullouts. Okay. With the new capital items and with the reserve and replacement budget, what we normally do is, by exception, we will have a consent agreement on that, a consent vote. So this is your opportunity now. If you want any of these items pulled out to be discussed and voted on separately, now's your chance. All right, Roberta, do you have any? All right, Jack, do you have any?
Yeah, the pickleball.
The pickleball lighting?
Yeah.
Anything else?
I do have a question about the cardio equipment for Beardsley. Is that something, do we need to replace all of it? Can we do half of it? If we're gonna You could, if we did half of it, we'd save $60K.
This was answered at the BNF meeting, but we'll let Carl go ahead and answer it.
Okay, thank you.
Ultimately, that's not our program. It makes it complicated because it's on a five-year turn, so we replace 100% of the room. And I believe that the product is actually worked through and used to that point, so that wouldn't be my recommendation back to you.
And those are purchased, not leased, correctly?
Correct.
Okay, all right. Ann, do you have anything you want to pull out?
Just the pickleball, and that's already been addressed.
Okay. Dick, do you have anything you want to pull out from
No,
the?
we've already, the budget and finance had wanted pickleball, the lighting for 309.
Okay. Sharon, how about you?
Yes. Number one was I wanted to know about the, I have to find it on here again, R.H. Johnson parking lot, and I talked to Cliff about it a little bit. I understand that we have a 2 years, Hillcrest isn't willing to talk to us about whether or not that parking lot would be part of their request from us, and so they're not going to talk to us for 2 years. I understand that when we repave that part of the parking lot, it's good for 5 plus years. So if we're going to go back and talk to Hillcrest in 2 or even 3 years, why don't we wait 1 year on this, or just pave up to the part where we would be negotiating with them about taking that over?
I don't have a crystal ball on Hillcrest's decisions. We're not.
Let me take that.
Okay.
The general manager has talked to the Hillcrest people just this week, and their plans are indefinite. So,
Okay.
all right. Anything else, Sharon?
Just ask originally about the golf carts that are on here. It said on our budget and finance information we have 20 at each one of them. So there are only 20 on here that I could find, unless I've missed it. Is it for 20 or 40?
No, it's 20. The R&R budget goes out 5 years, so there's 20 each year. That's probably what you were looking at.
Well, they're different golf courses.
Yes.
So it's 20 at each one of them, or 20
No.
just?
20 a year, and they rotate the golf courses.
Okay.
What they actually do is, if there's carts at certain golf courses that need to be pulled, they'll pull those and just distribute the 20.
Okay, thank you.
Okay. Okay? Okay. So we will pull out the pickleball lighting, and the rest will be on a consent vote.
Could
All
I
right.
have a question?
Sure.
Why is pickleball lighting being taken out? It came as a recommendation from property, so I would like an explanation.
Okay. Jack, you started it. How about you?
Fair enough. See, that's what happens when you speak up. You know, it's the way I look at it is that the original agreement on capital items was about 5.2 or whatever the original number was, and with the additions that came about because of inflation, those kinds of things. My feeling is we need to remove $300K to bring it back down to the original, what we agreed upon, 5.8. We're up to 6.1 now, and if we take it back down to our original 5.8, one way to do that is to remove the pickleball. And it doesn't, the lights will still work. They're not gonna be in the dark or anything, but I just think that's something we can postpone.
We'd like to refer back to Carl, too. Carl, you had some comments at the last BNF meeting on substituting out the LED lights?
Yes, so after providing you the facts and findings on the return of investment, I am continuing to work with the original manufacturer of the lighting, and I hope to come at a near future date, maybe the next budget, and actually find a cheaper way of doing this and still meeting our energy conservation needs. I don't know what that return of investment would look like in the end, but it's probably going to be much cheaper than what I currently have provided you.
Okay. Any other questions? All right, thank you, Carl. We'll move on. Future budget development considerations, credit cards, application of annual dues, increase indices, indicators, reserve fund budgeting. Is that you, Cliff? These are topics that have been discussed during the budgetary process that for one reason or another have been postponed or moved off to the next year. And they included, there was a lot of talk on credit cards. The amount of money that we spend to accept credit cards has gone over $500,000 a year. It's a significant expense. There was a lot of discussion on whether we should continue to absorb it as a cost of business or whether we should pass it on. There was also a lot of discussion of where we pass it on. There was discussion just pass it on to membership and golf, or just membership or golf. So it was undetermined, so it will be put off until a future consideration. There was also a lot of conversation about the process by which we go through estimating how much the due should go up. Okay, and Cliff mentioned CPI, the Computer Price Index. There are indexes out there that track pricing, and in fact, CPI is synonymous with inflation. So one of the things that came up that will be asked of the Budget and Finance Committee to look at is finding an index that we can use to index as a guide to increase dues. Over the last couple of years, inflation has been 8, 6.1, that sort of thing. It can be used as a guide, but exactly what index we would use and how we would apply it is up for discussion that the B&F Committee will look at next year. Okay? I think that's it. So, any questions on that? I mean, there's a lot of discussion has been on this at several of the committees too. 3.12, Governing Board Committee Calendar Draft. I think all of you have received a copy of the draft for the calendar next year. Now, committee chairmans have not been decided. They won't be decided until later. But if you have any comments or changes or recommendations, that sort of thing, you need to get them to Karen, because she's got to reserve the rooms for the various committees, and it's kind of a lengthy process. So if you have any, please refer them to Karen. Does anyone think they're going to have changes? Undetermined at this time, Karen.
No, I'll say no.
No? Okay. All right. Item 3.13 is the 23-24 Governing Board Officer Declaration. We'll have elections at the next meeting. If there's anyone that will be continuing on as a director that wishes to declare that they would like to run for an office, now is the chance to do it. You don't have to declare right now. You can wait until the 20th, but if you want to declare for something, now's the time to do it. Jack?
I would declare for vice president.
Okay. Can you tell us why?
Well, I think that the secretary position has given me a lot of insight into how the board works in my first year. I think that with that and the experience of leading the Chartered Clubs Committee, I think I've got a lot to offer in terms of experience, a year under my belt, plus what we've done with the Chartered Clubs Committee, I think speaks for itself as well.
Okay. I intend to run for president again, and I think my service this year has been a good foundation. I think I've held good meetings. I think I've kept the board operating correctly. There's been very little discord with the board this year, which I compliment all my fellow directors on, and I will declare for president. Dick?
I'll declare for treasurer next year,
Okay.
mainly in the interest of continuity. I would say that this is a job that you really need to do over multiple years because it'll get easier every year for you.
Okay. Kay, do you wish to declare? Okay. Lisa's not here. We'll wait to see if she has to declare, and once Alan and Christine are sworn in, we can ask them if they want to declare too. They will be sworn in at the general meeting on the 20th? Yes, okay. So we're down to governing board comments. It's been a long meeting. I appreciate everybody's patience. Roberta, do you have any comments? Harry? Jack?
No.
Ann?
No.
Dick?
No, thank you.
Sharon?
Yes,
Okay.
I just want to notify everybody that as of April 24th, there will start a autonomous shuttle service in Sun City. It was the project that was offered here but turned down. And so we went to Sun City. They're going to start a $2 million project with autonomous vehicles. And they will start an 8-mile circuit. They're out marketing the program as we speak, and it'll continue for 2 years. There'll be more shuttles added to it as it goes, so.
Okay. Sharon, I would say that as you go on, as you leave the board and you get involved in these other projects, as you have updates, would you let us know?
Sure.
Okay.
Absolutely.
Thank you. Kay, any comments? Okay. Member comments. Are there any members that have comments? Please come up to the microphone, write your name, give us your name and rec number, and we will listen to your comments.
Bill Weaver, 124087.
Welcome, Mr. Weaver.
This is just a couple accounting questions. On the capital improvements list, if you tally up the new capital, it comes to around 291,000. But if you look at the dues modeling, it says new capital spending is 692. I don't know why those differ. And then I'll give you one other, because Cliff will probably have to answer this one too. If you look at the fully funded balance on there, it's around 54 million. And if you go to the last year's financial annual report, it has, it says the estimated current replacement cost of everything in the community is 90 million. I don't know why those two numbers differ. I don't know what supports the 90 million in assets versus the fully funded balance number of 54 million.
Okay, Cliff, if you can answer that quickly. Otherwise, Mr. Weaver, I'd ask you to come up and talk to Dick about that.
Sure.
So real quick on the new capital on the modeling also includes allowance. So there's 400,000 in allowance that makes up, and then we could talk about the cost of the assets and the fully funded balance offline.
Can I borrow yours?
All right, thank you, Cliff.
Thank you. Tom Jones, 110390. I'm the president of the Automotive Restoration Club, and I'm remiss that the last time I came, I did not have raffle tickets for the 2016 Mustang convertible. I brought them with me today. The tickets are $20 each, or 6 for $100. They're available now, and you can see me after the meeting. Thank you.
When is the raffle?
The raffle will be February 10th of next year at our
geez.
car show. But remember, buy early and buy often, kind of like voting in Chicago, right?
Thanks for getting a jump on that, Tom. All right, are there any other comments from the audience? No? Sure, go ahead. Yes. Right. Roberta's no, because that's going to be handled by operations. And Jack, no, because he has additional input to bring to us before we can bring that to a vote. So, all right. Having concluded our business, I will adjourn the meeting at 10:43. Thank you, everybody.